Extra Space Storage Stock, ticker symbol EXR. This is one of the largest space storage REITs in the US, and a lot of things happened recently. First of all, on the 3rd of August, EXR presented quarter results where FFO was in line with expectations, and revenue had a small miss. The stock went down 10% after earnings, which is very interesting. More on that in a minute. The reason why people love EXR so much is because of the dividends, and I get why. Dividend yield is at 3% and the 5-year growth rate also looks really good. So with the stock coming down, could this be the perfect moment to buy EXR stock? Well, I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does EXR do? Extra Space Storage is a fully integrated real estate investment trust that owns, operates and manages self-storage properties in the US. Let's dive in the earnings report. EXR reported a net income of $1.5 per share, representing a 13.3% decrease year over year. And to be honest, this doesn't look good. FFO was reported at $2.06 per share, representing a 3.3% decrease year over year, also not looking that good. Same-store revenue increased a tiny bit, which is very nice, and so did the NOI. Occupancy rate was reported at 94.5%, which is also a decline versus last year. This is also something that I don't like, of course. Dividends were also paid, sitting at $1.62 per share. And keep in mind that this current dividend is a little bit different because of the merger agreement with Life Storage. EXR will pay an additional dividend for the 3rd quarter, keeping up with EXR's customary quarterly dividend timing. With this total dividend sitting at 1.62, we see that dividends are very well covered with the FFO, so this looks good to me. And one of the reasons why the stock fell was because of the outlook. Core FFO was expected to have a range of $8.3 to $8.6 for the full year of 2023, but they lowered this to a range of $8.15 to $8.35. Same-store revenue growth and expenses growth were also lowered, and same-store NOI was also lowered big time. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue with diving into the fundamentals. EXR is a 17 billion market cap company, making them one of the larger self-storage REITs in the US. PE ratio isn't the best way to value a REIT, so I will be using the price to FFO instead. Right now it is sitting at 16, indicating it is around its fair valuation. Later in this video I will show you my 3 price targets for EXR, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 2 billion, and in this graph we see that revenue went up really nice and steady. With the recent acquisition of Life Storage, this will increase only even more. Margins were going up in the past decade, but most recently they have come down a bit, which is something to keep your eye on. EPS did increase in the long run, and this is pretty similar to the margins. To me, this looks really good. Analysis expect high single-digit growth in EPS in 2024 and moving forward. But in 2023, EPS will decrease according to the analysts. For the revenue, it is looking really good with double-digit growth in the coming years. Return on assets is sitting at 9.6%, which is a great number. Return on equity looks really good, and the most important number, return on invested capital, is sitting at 8.7% and not the number that is displayed here. Probably a bug or something. Current ratio is at 0.18, which looks pretty low to me. And right now EXR has roughly 7.7 billion in debt. To me it is very important that companies can pay down a big chunk of their total debt. Right now EXR has 50 million in total cash, so this doesn't look good to me. However, companies like EXR have a higher debt versus regular companies, so that is something to keep in mind. But still, it's very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow was growing pretty nice and steady, but most recently it took a hit. So again, something to keep your eye on. Shares outstanding are increasing, which is not a good thing in general. But since this is a REIT, I don't mind that much, since they issue new shares to raise capital and grow the business. But when shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 3%, which is a great number of course. Keep in mind that current annual payout and last announced dividend give a bit of a diluting image, since they split up the dividend due to the merger with Life Storage. Payout ratio is at 75%, which is the average for REITs, so this looks really good to me. The 5-year growth rate is at almost 80%, which is an insane number given the fact that it is already yielding at 3%. And on top of that, they increased the dividend for 12 years in a row, which is very impressive. And if you take a look at these numbers, the dividends paid since 2012, you see that EXR likes to increase the dividend and keeping their yields very high. In this graph we see the expected dividends in 2023, 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It is expected to grow at historical growth numbers, which is very nice. Overall these dividends look pretty good to me, but how about the historical returns? I decided to compare EXR stock with the overall market, in this case the S&P 500. Next to that I added CubeSmart and Public Storage. On the 5-year chart we see that EXR underperformed the S&P 500 with a small difference of only 5%. But if you take a look at the chart, it was crushing the S&P 500 until most recently. Both Cube and PSA underperformed the S&P 500 as well. Keep in mind this chart is including dividends. On the 1-year chart it looks pretty different, with EXR returning minus 30% while the S&P 500 is sitting at 10%, beating all the stocks in this list. On the 6-month chart it is EXR again with minus 20% return versus the S&P 500 sitting at 9% return. On the 1-month chart it is EXR another time with a minus 10% return, while the S&P 500 is beating every stock in this list again. So bottom line, EXR was beaten by the S&P 500 in the long run due to recent events. So is this the perfect time to buy EXR stock after the stock fell down big time? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 8, 10 and 12% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 40, 41 and 42. And for the free cash flow margin I'm putting in 85, 60 and 62. For the PE ratio I'm putting in 20, since this isn't a fair way to value a REIT. For the price to free cash flow I'm filling in 15, 16 and 17. It's a massive company that is still capable of growing, but it comes with some risks of course. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now EXR stock is at $128. I hit analyze and we see a lot of green numbers. Since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $141, a mid price target of $175 and a high price target of $218. To me, the low to mid price target is the most justified here, indicating that this stock is undervalued based on this number. My final conclusion on this stock is that I love the recent decline in stock price. A lot of things have been said about the merger and occupancy rate falling. And yes, occupancy rate is a thing to keep your eye on. But other than that, it looks pretty solid. The dividends are looking really good and I love how steady and consistent this company is. Next to that, with the recent acquisition they will increase the revenue and shareholder return big time, which is also a good thing in my opinion. For now, I'm adding more shares to my portfolio. The price is looking really good and I'm long on this company. They have beaten the S&P 500 big time in the past couple of years, up until most recently. So let's see what the next couple of years will bring us. And remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.